Hey there, and welcome back to another week of your Mortgage Market Movers Weekly, where we are discussing everything that's going on in the economy and in the real estate world to help you make more informed decisions. Last week we had a strong jobs report, and this week we have a very, very important meeting. We will discuss that later when we're going over the charts, so be sure to stick around. If you're just here for the mortgage rates, the 30-year fix is down to a 6.76. Of course, that is the average 30-year fix. That is down from, I believe, 6.81 from the previous week. Looks like rates are coming down a little bit. I think that they are stabilizing somewhat, but we're going to take a look at that whenever we get to the charts. So without further ado, let's go over to the charts. All right. We have the U.S. 10-year pulled up, and if you are not familiar, the U.S. 10-year is what we use as a proxy for the 30-year fixed. Of course, it is not the 30-year fix, but it does let us know which direction we're heading in, and it lets us look at patterns and also some of the volatility that we've been discussing. All right. In case you didn't know, the 30-year fixed is based off the U.S. 10-year yield, and as we're looking at it, it looks like rates have come up a bit. So they were dropping fairly consistently. So this is a daily chart, and all of these little candles, they're called, when it's red, it means that the rates opened and they moved down that day. When they're green, it means they opened and moved up that day. We had a high of 4.809 for the yield, and typically the spread between the yield and rates, it's about 1.5 to 2%. So this is when rates would have been their highest recently. So this year, back in January 14th, the 10-year yield was getting up and it hit a high of 4.809. And ever since then, we've seen this decline. Might have creeped back up, but we've seen a nice decline all the way down to 3.862. This is when rates would have been their lowest recently as of this year, and that was April 4th. Now, since then, we've seen this volatility, and this is just crazy volatility right here. I mean, this is just showing that the rates really that day could have fluctuated a good bit, right? If you were waiting on April 4th to lock in your rate and you decided to wait over the weekend, you probably had a rude awakening that following Monday. And what we've seen is it looked like they were coming up fairly consistently. So 1, 2, 3, 4, 5 days of rates just climbing, and they've slowly started to come down, and some of that volatility is dissipated. So as you can see, these bars are not quite nearly as large as this. And that just came from, it was macroeconomic factors, and we won't dive too deep into that right now. Just know that there was a lack of confidence in the U.S. Treasury notes, and the yield is inversely related to the bond market. So higher yield is because people aren't buying bonds as much, and the yield is an incentive to buy bonds. So yield up, bonds down, and vice versa. So when we look at this chart, this is the TLT, and this is going to be our proxy for the bond market. And as you can see, this is inversely correlated when bonds are buying. So this upswing, that's people buying, the yields are going down. So we've seen this year that the bond market, people are buying into the bond market, but right around this time frame of April 7th, the bond market had a quick decline, and it looks like people were rushing away from bonds. What's a little scary is typically there's also this doesn't have to be the case, but typically there is an inverse relationship between the stock market and the bond market. Stocks are riskier assets, so when people are not buying stocks, they are rushing to bonds because they tend to be safer. However, people were dumping both bonds and stocks, and they were rushing to gold. Okay, so that is not the most comforting thing. But it looks like some of that volatility has died down, and people are buying bonds. People aren't just dumping all of their bonds, right? That's what I'm trying to get at. People are still investing in treasury bonds. And really, if we want to see rates come down, we want to see this bond market start to flourish and people start to buy bonds again. So that's where we are as far as the rates. The 10-year yield, which is what we use to guesstimate where the rates are going. We have seen this incline right here in the yield, and that's because the stock market has been doing fairly well recently. And like I said, there tends to be a relationship, a negative relationship between the bond market and the stock market. So as stocks are set to rally, we're going to see the bond market not perform quite as well. That's what tends to happen. That doesn't mean that definitively will happen. So we will see what happens. Obviously, nobody knows, but we can make informed decisions. All right, let's go over to... Okay. Let's take a look and see what events been going on lately. So I mentioned that we had a solid jobs report. So it looks like we had that last Friday, May 2nd, and this is the information data. So really, this isn't anything really too much that I want to dive deep into. It's not super pertinent for real estate in the sense that the jobs data was not bad. It was a solid jobs report, and it just looks like we don't have to worry about, any negative repercussions coming from the jobs side of things. Inflation is another story, and we have to keep our eyes on that. But as of now, it looks like, from the employment side of things are not terrible. We had the unemployment rate at 4.2%. That has been consistent month over month. I believe this is monthly. Monthly. So 4.2%. It is not ticking up. That's a good thing. We don't want to see more unemployment. This week we have, and I'm recording this May 6th, Tuesday, and as of today, tomorrow we are having the FOMC meeting. And this is an important meeting. It's always important. And what this is, it's the Federal Reserve discussing their plans moving forward, if they are going to do any rate cuts, any plans for rate cuts in the future, and their forecast of the economy. It's a pretty big deal. This one, I will say, we have this little tool that we can look at right here, probabilities. And this tells us, are we looking at a pause, a hike, or a cut? And right now, it's a 96% chance of tomorrow's rates being paused. Okay. So, we always want to listen and see, because there is a press conference at the 2:30 time slot. So it's important to hear predictions for the future. That's really going to impact very, very, very heavily the stock market, which also, like I said, will impact the bond market, which will impact rates. So we really want to listen to that, and we want to hear what Jerome Powell, the chair of the Fed, has to say, and whether he's optimistic or pessimistic towards the economy moving forward, if we're going to get any rate cuts or no rate cuts. Right now, when we go back to that tool, we are pricing in the stock market is pricing in one rate cut here. This is a 55% chance in July. One right here. That makes 2. And then 3 for the year. So this has been fluctuating between 0 rate cuts, 1 rate cut, 5 rate cuts at one point, and now it has settled down at 3. So this is something that will more than likely change tomorrow as we listen to that press conference. But right now, 96% chance of pausing rates, and then we are looking at 3 potential rate cuts this year. When I say rate cuts, that is not mortgage interest rates, but it is the Federal Funds Reserve rate, which is more like bank rates, right? So if you want to borrow money, and that would of course be to stimulate the economy and make it easier for individuals to borrow money. All right, so that's really the big thing. It is good to look at these like consumer credit things, outstanding consumer credit. We want to see, are people spending more money? We want to see what that credit looks like. I know that credit delinquencies, I think, were on the rise. That is not good news, and it does not bode well for the economy, but we will see. We also have unemployment claims. Anything else that is particularly interesting? Really, I mean, this FOMC is going to be really the biggest thing. So that's what we want to watch. When we get over to the rates, like I said, down to 6.76. I would assume that this week is when this is going to pop up. And I would assume it's going to be a little bit higher. When we were looking at the chart, we saw that the rates had been climbing daily. So I would assume that this will tick up ever so slightly. But, it's still not as bad as, where was it? Like in January, it was 7.04. So, we are a little ways away from that. So hoping for that stability in the rates where it's not so volatile. We don't want to see these huge jumps. It makes it fairly difficult, right, to know what's going on. We want more certainty in the market. So we are hoping for that. And I think that's all we have for this week. So if you guys have any questions, reach out to Mortgages by Linda. You can find our website at mortgagesbylynda.com. We have a little apply button if you are interested in a home loan, whether you are looking to purchase a home or if you are looking to refinance your current home. Give us a call at 877-TEAM-MBL, and we will catch you guys next week. Have a good one. Bye.